Short answer is the easiest way for you to get wrecked, but you want the long answer, don't you? Well, let's get right to it. Hey guys, in this video we're going to cover what futures trading is all about. The first thing to note about futures trading is you are speculating, aka guessing what the price of the token would be in the future, hence the word futures. However, some guesses are more intelligent than others. There are those who do tons of market research and analysis before opening a futures trade. They check the news, data, and market sentiments, and there are those who just open a trade based on hype news or gut feelings. Guess who's getting wrecked faster? When trading futures, you either speculate that the price will go up, aka longing a trade, or that the price will go down, aka shorting the trade. Now here comes the next and interesting part of futures trading. Leverage. When trading futures in crypto, you need a leverage. That simply means borrowed money. This is where the X is coming. If a person opens a futures trade and takes a 10x leverage on $100, that person would be borrowing $1,000. That's 10 times 100. So if a person opens a 10x leverage with $100 and predicts that the price of Bitcoin will go up, that is using $1,000 of borrowed money to predict that the price of Bitcoin will go up, longing, and Bitcoin does indeed go up by 10%. The person would have turned $1,000 to $1,100. That's $100 profit. An amazing 2x from your initial investments. That's amazing, right? Wrong. The next key takeaway about leverage trading is that your initial investment, the $100 in this case, is used to cushion the effects of the price movement against you. For example, imagine using a pillow to stop a pebble thrown at you. Now, imagine using a sheet of paper to stop a meteorite hurling towards you. That, my friend, is what it means to get liquidated. The more X's you take, the higher the risk of getting liquidated. In the case of our analogy, more X's means it goes from pebbles to stones, to rocks, to boulders, to large meteorites. Liquidation is a very notorious feature of the cryptoverse, and personally, I wouldn't recommend leverage trading. Cryptocurrencies are volatile enough as it is. Taking leverage to trade volatile assets is just a fancy way of gambling. Before moving on to our next key takeaway, I would deeply appreciate it if you can help take this channel to the moon. It's free, it's simple, all you need to do is just subscribe. Okay, let's get right back to it. When speaking about liquidation, it's also important to understand what margins are. Remember when I said your initial investment acts as a form of cushion to the price movement against you? Now, imagine that the strength of that cushion is the margin. If there's a strong price movement against you, your margin, aka buffer of cushion in this story, gets broken and it's what leads to liquidation. And I'm sure you've heard of how a lot of reckless trades get liquidated in the cryptoverse. Usually before liquidation occurs, traders get what's called a margin call. This gives them a chance to add more money to their initial investments in order to strengthen the cushion or buffer. Some traders are lucky enough to avoid liquidation after getting a margin call. Other traders,